What kind of company leaves billions of dollars on the table when customers are already waiting to buy? For most businesses, demand exceeding supply is a problem to solve. The usual response is simple: build more capacity, increase production, expand distribution, and capture the revenue before competitors do. Rolex appears to do the opposite. Its most desirable watches can be extraordinarily difficult to buy through official retailers. Customers may wait months or years. Some never receive the model they want. On the secondary market, certain watches have traded above their official retail prices, turning availability itself into part of the product's appeal. That has created a familiar explanation. Many people assume Rolex deliberately restricts production to manufacture scarcity. The logic sounds convincing. Produce fewer watches than the market wants, make each one feel more exclusive, and let the shortage strengthen the brand. But Rolex has publicly rejected that interpretation. The company has said that the shortage of its watches is not a strategy. According to Rolex, demand has exceeded its production capacity, and increasing volume cannot come at the expense of product quality. That statement creates a more difficult question. If demand is so strong, why has Rolex not expanded faster? This is not a small workshop producing a few thousand handmade pieces each year. Rolex is one of the largest luxury watchmakers in the world, with annual production estimated at well over 1 million watches. It has enormous brand recognition, a global retail network, and enough demand to sell far more of its most popular models. In almost any other industry, that would be an invitation to scale aggressively. A car company with long waiting lists would add shifts and open new plants. A technology company would increase orders from suppliers. A fashion brand would push more inventory into stores while demand remained hot. Rolex does not operate that way. It expands but slowly. It controls where its watches are made. It controls which retailers can sell them. It protects a production system built around consistency, durability, and strict quality standards. And when demand rises faster than that system can grow, the company allows the gap to remain. That choice has visible costs. Every customer who cannot buy a watch represents potential revenue that Rolex does not collect. Every model resold at a premium creates value that initially goes to dealers, collectors, or speculators instead of the manufacturer. So why tolerate it? The simplest answer is that Rolex cannot make enough watches. But that answer is incomplete. The real issue is not whether Rolex can produce more. The issue is how much more it is willing to produce, how quickly it is willing to expand, and what it might risk by allowing short-term demand to dictate the size of its business. To understand that decision, we have to look beyond the waiting lists and the resale prices. We have to look at the system Rolex is protecting. To understand that system, it helps to begin with something that makes Rolex fundamentally different from many luxury brands. The company does not simply design watches and outsource the difficult parts. Over decades, Rolex has built an unusually integrated manufacturing network that keeps critical stages of production under its own control: cases, bracelets, movements, dials. Research laboratories, quality testing, and final assembly are concentrated within facilities that the company manages directly. According to Rolex, this structure exists to maintain complete control over manufacturing quality and long-term reliability, rather than to maximize production speed. That philosophy influences every decision that follows. Increasing output is not as simple as installing more machines. Every additional watch depends on highly trained specialists, precision manufacturing, extensive testing, and production processes that cannot be compressed indefinitely without affecting consistency. Building that capability requires years, not months. The same logic extends beyond the factory floor. Rolex also exercises tight control over how new watches reach customers. New watches are sold only through officially authorized retailers that meet the company's standards. Those retailers are responsible not only for selling the product, but also for representing the brand, providing after-sales service, and maintaining the customer experience that Rolex expects around the world. In other words, production and distribution are designed as one connected system. This matters because luxury is different from mass-market manufacturing. If a consumer electronics company fails to satisfy demand, customers often switch to another brand. The primary objective is usually to produce enough units before competitors capture the opportunity. Luxury brands compete under different conditions. Customers are not only purchasing technical performance, They are purchasing craftsmanship, heritage, trust, reputation, and the confidence that the product will continue to represent those qualities many years after the purchase. Protecting those intangible assets often becomes just as important as increasing quarterly sales. Rolex occupies an especially unusual position within this market. Industry estimates from Morgan Stanley and Lux Consult suggest that Rolex produced roughly 1.18 million watches during 2024, making it by far the largest Swiss luxury watch manufacturer by sales. This is already industrial-scale production by the standards of high-end mechanical watches. Yet the waiting lists remain. That creates an important distinction. The shortage does not apply equally across every Rolex model. Demand is concentrated around particular collections that have become exceptionally desirable among collectors and consumers. Some references attract significantly more interest than others, meaning that what appears to be a universal shortage is often a shortage concentrated in specific products. Meanwhile, the company continues investing for the future. Rolex has announced the construction of a new manufacturing facility in Bull, Switzerland, expected to begin operations later in this decade. The stated purpose is to support future growth while preserving the standards that define the brand. The announcement itself reveals something important. Rolex is not refusing to expand. It is expanding according to its own timetable, rather than responding immediately to every surge in market demand. That difference may seem subtle, but it changes how the entire business should be understood. The question is no longer whether Rolex recognizes the financial opportunity sitting in front of it. The evidence strongly suggests that it does. The more interesting question is why a company with the resources to grow chooses a pace of expansion that appears deliberately slower than the market is asking for, even when every additional watch could almost certainly find a buyer. The turning point appears when we stop thinking about production as a factory problem and start thinking about it as a capital allocation decision. Every company faces the same temptation when demand suddenly exceeds supply. Expand quickly, hire faster, build more factories, increase volume before competitors catch up. On paper, that strategy looks rational. More units sold should mean more revenue, more profit, and greater market share. But it also assumes that demand today will remain equally strong tomorrow. Luxury businesses know that assumption can be dangerous. Demand for high-end goods is influenced not only by income, but also by confidence, financial markets, consumer sentiment, and cultural trends. When those conditions change, demand can cool surprisingly quickly. A production system designed around peak demand can become a source of excess inventory only a few years later. That possibility changes the economics of expansion. Building a new manufacturing facility is not simply a matter of spending money. It requires acquiring land, installing specialized equipment, recruiting and training skilled workers, validating production processes, and integrating every stage into an existing quality system. These investments are measured in years rather than quarters. Rolex's decision to build a fifth manufacturing site in Bull illustrates exactly that approach. The company is investing in additional capacity, but the project reflects long-term planning instead of an attempt to satisfy immediate shortages. The new facility is expected to become operational only after several years of construction and preparation. That timeline reveals something important. Rolex is willing to spend heavily on future capacity. It is simply unwilling to sacrifice the pace at which that capacity is built. The alternative would have been far more aggressive. The company could have outsourced more manufacturing, accelerated supplier expansion, loosened production constraints, or dramatically increased distribution in order to capture today's extraordinary demand. Instead, Rolex continues relying on a tightly controlled production system that grows gradually. At first glance, that seems expensive. Every watch that cannot be delivered through an authorized retailer represents revenue that is postponed or never realized. Customers who cannot purchase immediately may turn to the secondary market, where the additional value created by strong demand is captured by resellers rather than by Rolex itself. From a short-term financial perspective, that appears inefficient. Yet the opposite strategy carries costs that are much harder to reverse. Suppose Rolex expanded aggressively to satisfy every customer waiting today. Factories would need to operate at much higher capacity. Retailers would receive significantly larger inventories. the market would gradually become easier to satisfy. But what happens if demand later returns to more normal levels? Luxury history offers many examples of brands that expanded too aggressively during periods of exceptional demand, only to face discounting, excess inventory, weakened pricing power, and damage to brand perception when conditions changed. Those outcomes rarely happen overnight. They emerge slowly as supply begins to exceed the level of desire that originally made the product valuable. This is where another piece of evidence becomes important. Prices in the secondary watch market have not moved in only one direction. After reaching extraordinary highs during the pandemic-era boom, many luxury watch prices corrected as financial conditions normalized. Although several Rolex models continued to retain remarkable value compared with many consumer products, the market demonstrated that demand itself is not permanently fixed. Seen from that perspective, expanding production according to the highest point of market enthusiasm becomes a much riskier decision than it first appears. The real question is no longer how many watches Rolex could sell today. It is whether chasing every sale today might weaken the very system that allows the company to keep attracting customers decades into the future. The evidence points toward a conclusion that is more nuanced than the popular explanation. It is tempting to believe that Rolex became successful because it created scarcity. The sequence appears obvious. The watches are difficult to buy, demand keeps rising, resale prices remain strong, and the brand becomes even more desirable. But that interpretation reverses the order of cause and effect. Scarcity alone does not create a luxury icon. If it did, every manufacturer could simply produce fewer watches and expect the same outcome. History shows otherwise. Many limited products disappear without creating lasting value because customers never believed they were worth pursuing in the first place. Scarcity only increases value when it protects something people already trust and genuinely want. That distinction changes how Rolex should be understood. The company's manufacturing standards, long-term investment in production, strict quality control, global service network, and decades of consistent execution created an extraordinary level of trust long before today's waiting lists became a defining feature of the brand. Only after that trust existed could limited availability begin reinforcing the brand's position. This is where the business logic becomes much clearer. Rolex does not need every interested customer to buy a watch immediately. It needs customers to continue believing that owning a Rolex represents exceptional craftsmanship, reliability, and lasting value. Those beliefs are strengthened by several reinforcing mechanisms working together. Controlled production protects manufacturing consistency. Carefully managed distribution prevents widespread discounting through authorized retailers. Strong confidence in product quality supports demand in both the primary and secondary markets. Visible resale values signal that ownership carries value beyond the initial purchase. Each element strengthens the next. What appears to be a simple supply shortage is actually part of a much larger system built around preserving confidence over decades. An important example illustrates this approach. Rather than ignoring the secondary market, Rolex introduced its certified pre-owned program through selected authorized retailers. Watches sold through this program are inspected, authenticated, and accompanied by an official international guarantee from Rolex. The company is not attempting to eliminate the secondary market. Instead, it is bringing part of that market into an environment where authenticity, quality, and customer confidence remain under its influence. That decision reveals a consistent philosophy. Rolex is not focused only on manufacturing watches. It is managing the entire life cycle of ownership. Academic research on luxury consumption reaches a similar conclusion. Consumers often associate exclusivity with greater symbolic value, but only when that exclusivity is supported by authentic quality, craftsmanship, and brand credibility. Artificial scarcity without those foundations rarely produces sustainable competitive advantage. This is why the shortages surrounding Rolex should be interpreted carefully. They are not convincing evidence that the company simply withholds production to create excitement, nor are they merely an unavoidable consequence of operational limits. Instead, they emerge from a series of deliberate choices about what the company refuses to compromise. Rolex accepts slower expansion. It accepts waiting lists. It accepts leaving some short-term revenue unrealized. because those outcomes are considered less damaging than weakening the standards that built the brand in the first place. Seen from this perspective, the shortage is no longer the explanation for Rolex's success. It is the visible result of a business system that consistently prioritizes long-term trust over immediate volume. And once that possibility is recognized, the discussion shifts away from watches themselves toward a much broader question about how enduring companies decide what not to maximize. Seen as a whole, Rolex's strategy begins to look very different from the popular narrative. The company does not appear to be pursuing scarcity as an objective in itself. It is pursuing something else. It is protecting a business system whose value depends on remaining trustworthy over generations rather than maximizing every sales opportunity in the present. That distinction explains why Rolex can continue investing in new manufacturing capacity while refusing to accelerate expansion beyond what its own standards allow. Those two decisions are not contradictory. They are complementary. The company is preparing for future growth, but it is doing so at a pace that preserves the qualities customers associate with the brand. Faster production would generate more revenue today only if it did not weaken confidence tomorrow. Rolex appears to believe that this condition cannot simply be assumed. That belief also explains why waiting lists, controlled distribution, manufacturing discipline, and the secondary market should not be viewed as isolated phenomena. They reinforce one another. Customers trust the quality because the company protects its manufacturing process. Authorized retailers protect pricing discipline and customer experience. Strong confidence supports demand in both new and pre-owned watches. Healthy resale values reinforce the perception that ownership retains value over time. That perception encourages more people to join waiting lists instead of searching for alternatives. The system continuously strengthens itself without requiring Rolex to maximize production at every opportunity. Of course, this approach is not without trade-offs. The company leaves short-term revenue unrealized. Some profits created by extraordinary demand are captured by independent resellers rather than by Rolex itself. Potential customers sometimes become frustrated by limited availability. These are real costs. But Rolex appears willing to accept those costs because it considers a different outcome even more expensive. If rapid expansion weakened pricing power, increased discounting, diluted customer confidence, or reduced the sense of long-term value surrounding ownership, recovering those intangible assets could take decades. Factories can always be built. Reputation is much harder to rebuild. That is why the most important resource Rolex manages may not be steel gold or manufacturing capacity. It is customer expectations. The company does not simply decide how many watches to manufacture. It decides how quickly its entire ecosystem should grow. That is a fundamentally different management problem. Most businesses treat excess demand as evidence that supply must increase until the gap disappears. Rolex demonstrates another possibility. Sometimes the greater challenge is deciding which demand should be satisfied immediately and which demand should remain unmet because preserving the system that creates long-term value is more important than capturing every available sale. Viewed from that perspective, the waiting list is no longer the story. It is merely one visible consequence of a much deeper strategic choice. Rolex did not build one of the world's strongest luxury brands by asking how many watches it could sell this year. It built that position by deciding that demand should never become the only force determining how the business grows. And that may be the broader insight behind the company. The strongest competitive advantage is not always created by producing as much as possible. Sometimes it is created by managing demand with enough discipline that every decision made today protects the value customers will still believe in decades from now.